Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today we're here with my co-host Styler Steinke, and we are joined by John Araneo with Cole-Frieman. John, thanks a lot for joining us today.
Thanks for having me. Great to see you guys.
This episode is brought to you by our friends at Richey. Richey provides audit and tax services for alternative investment funds. You could find the link to their website and contact information below in the description. Now back to the episode. So today, this is part of our short series for a new fund launch. Throughout the series, we've covered fund admin, audit, banking. Today's episode is featuring John. We're going to be getting into the legal details of starting a fund. So, John, why don't you give us a quick overview of Cole-Frieman and your services, and then open up by telling us, what does a fund formation lawyer do for a fund?
Sure. Thanks, Mike. Yeah. So my name is John Araneo. I'm a partner at Cole-Frieman Mallon. We are a premium investment management boutique law firm. We do a high volume of fund launches. We typically launch over 400 funds a year, which is somewhat of a staggering volume. But we do the fund formation in a way that's very process oriented. The nucleus of the firm is out in California. We have 3 offices. One in San Francisco, one in Denver, and one in New York City. We're about 30 plus lawyers and almost 50 employees. And we focus squarely on fund formation, working mostly with hedge funds, not so much PE, but we do a lot of VC, real estate funds, all sorts of hedge funds. And our firm has been particularly adept and developed a depth of expertise in the cryptocurrency asset class. So that's Cole-Frieman and Mallon. In terms of what we do and in fund formation, I think it's a great question. It's fundamental. There are typically the 4 horsemen, if you will, is colloquially referred to as the 4 service providers that you need to launch a fund, which is the lawyer, the PB if you're trading, the admin, and the auditor. So I think, the first fund I launched or worked on technically as a lawyer was in 2003. So I've been doing this for a while and launched hundreds of funds. And with that sort of data set and that being able to draw back on that body of work, the position of what a great, I think, fund lawyer will do, it's worth it to reframe the role. I think the best fund counsel that I've seen, some of my colleagues just in practice, counterparties, but the lead counsel, fund counsel will really act and function as like an architect and a regulatory navigator and also like an outside counsel. And what I think good fund counsel should do is design the structure around the fund strategy, investors, taking into consideration, obviously, tax implications and the fund's trading footprint. The net effect, I think, is to really affect the elegant translation of the fund strategy into coherent terms while staying ahead of regulatory risk. So that's a lot of what we do. And it's incumbent in that this is not really clerical drafting, it's business risk engineering, and there's an art to it. And I think there are some sort of compelling points that fund formation law firms will prioritize and focus on. Happy to sort of run through a couple of them unless you guys have any comments or questions.
Yeah, no, this is good. Yeah, let's maybe give us a quick, just the high level bullets of kind of what you guys do for a fund.
Yeah. So some of the sort of overarching considerations before we do the quick rundown. Investors, this really drives structure, selection, jurisdiction, investor routing. We're talking onshore, offshore, master feeder, mini master, parallel funds, SPV, all these exotic structures. They're aligned to your strategy and really your investor mix. You often have to navigate certain key exemptions of the Investment Advisors Act, the Investment Company Act, the securities laws. These things are routine. We'll get into that in a minute. But the art of good fund formation, again, is really translating the strategy into coherent terms. And those are around concepts of liquidity, valuation, things like gates and fees, and dealing with side letter strategy. I think, counsel will also have sort of a proactive regulatory radar, depending on how, for example, an emerging manager or startup manager may want to grow and anticipate needs after launch. But I think the value message for managers in one sentence is sort of to focus on the fees, liquidity, valuation clauses. All of these things can become the center of an exam or a limited partner dispute years later. So the real value of counsel is in the problems you avoid during formation. So it's important. Really happy to do a real quick through what a chronology looks like and some of the big pieces that we take down in a typical formation.
Yeah, why don't you give us the quick on that? Yeah.
Yes, usually the first step is we'll do a hedge fund questionnaire that'll focus on the basic terms, service providers, target AUM, things like that. Then we'll go into a stage, we'll do a schedule, and we'll project management, all of the homework, milestones that we need to reach, the tasks we need to accomplish, and the timing of it. There are certain counterparties that are involved. Then we'll do entity formations. We'll draft usually initial boilerplate documents for the entities that would allow us to get accounts opened without being dragged down to fully negotiate those operating agreements. So that's something we do at the beginning. Then we start drafting the offering document suite, which is typically the PPM, the LPA, the subdocs. It would include an investment management agreement, and we would circulate that to the auditors and the admins for comment. The next step is we'll sort of manage the service provider stack, and we'll negotiate, examine those agreements. We'll get the auditor engaged, and we'll assist client in opening bank accounts, which is very important to do that early on in the launch. Then we'll deal with sort of the regulatory filings, the Form D, if there's a CFTC, NFA exemption that's required, any sort of jurisdiction-specific filings. And then we will sort of go to launch. And then the day after launch, we'll strike the launch NAV. We'll complete all the initial closings, and then we sort of commence the ongoing compliance calendar from there. So in a nutshell, that's sort of the cycle of the major parts of the launch.
Cool. Okay, this is good. There's obviously there's a lot involved here. Obviously, it sounds like you guys should be one of the first, if not maybe the very first contact for a fund that's looking to launch. John, the one thing you brought up that I'd like to dive into just at a high level, you mentioned like jurisdictions. Talk to us about kind of how you think about jurisdictions for a fund manager. Maybe taking a step back, even, why would somebody choose a domestic fund versus offshore even?
Yeah. So basic structuring, that's a great question, and that drives really a lot of what we do. The predominant reason really to consider going outside of the U.S. is for your investors. There are typically three sort of buckets of investor types that might drive that. U.S. tax-paying investors, there's no need to have any offshore vehicles. If you are taking money from tax-exempt entities, U.S. tax-exempt entities, endowments, pension funds of the like, they would need to have what's referred to as an offshore blocker. That's the offshore feeder. Typically Cayman, maybe VVI. We would create that. That would allow these U.S. tax-exempt investors to invest their funds through that offshore feeder, and it would avoid unrelated business tax for those entities, or effectively connected income tax. So that's a reason to do that. There are other third type of investors are non-U.S. tax-paying investors, offshore investors. They similarly don't want to invest in a domestic vehicle. They would prefer to come through a offshore feeder, typically Cayman as well. This way, they wouldn't have any tax filing or tax implications in investing through the feeder. So that's the most common reasons why we would look to offshore jurisdictions.
Those are very good points. I guess, John, kind of go into that a little bit more. Obviously, talking about architecture, a lot of managers or even first-time managers think this can be kind of a go it alone type of venture, and definitely it's not the case at all, right? There's a lot of aspects, not even structuring, but taxes, elements of structure, not just on the investor side, but even on the fund manager side, right?
Yeah. I think we see that. We work with a lot of emerging managers, and they'll come to us with sort of a set of documents And that really works very well. And I think,
using like chat GPT to put this together or something.
either that or their cousin's fund documents, or, maybe they were a former lawyer. I mean, the inception of the documents and how they get traded on the secondary market, if you will, always amazes me. But they get these now with AI, they are a little bit more optically professional, which is actually a good point, because the point is not how beautifully written the documents are, but if you don't go through the process of, instead of trying to conform your business to a document that you received, that's the opposite. What you should do is have a discussion with counsel on how you want your business to work and what things, what regulatory issues counsel might bring up that's relative to your strategy that you need the documents to deal with. So it's the opposite. The business should drive the drafting of the documents, not trying to retrofit a manager's business into a set of documents so they can save $30,000 in doing it the right way. So there really is an art to that. Drafting these documents, which, yes, if you launched 10 different funds, you would go through the same type of documents that would have a lot of the same copy in them. You'd be dealing with a lot of the same exemptions and registrations, but they're incredibly different, and they need to be for a business to sort of operate and be as unique as they are, let the manager run the way it runs. So boilerplate kind of looks nice and it's seductive, but it never works well. And one universal rule is that when a manager, especially a new manager, wants to use a set of docs that they haven't really imbued themselves into, is that they're blissfully ignorant of the business that they're running, the questions the investors are going to have, and the challenges that they've come up. They're incredibly unprepared for that. So you're not buying a set of documents. It's really going through the process, understanding what's in them. And the words and the provisions in there are really defensive weapons for you if you're ever getting examined by the SEC or a regulator. And if you don't do the bespoke drafting, then those words are going to be weapons that are used against you because you're saying one thing and perhaps doing another, or the documents just don't make a lot of sense.
Yeah, for sure. On those thought processes there, John, obviously going through the fund formation process is one aspect, the architecture, the framework there. Once that's done, what ongoing legal services are provided as a law firm on your side? What's the ongoing activities that you would interface with the fund manager?
Yeah, so there's certainly a whole bunch. One thing that's unique about my firm is a lot of us are former general counsels. So there, as much as that we have an incredible depth of expertise in formation, like most fund formation law firms do, we also have a good amount of different breadth of expertise in the type of post-formation, post-launch legal tasks that need to be done, the challenges that our clients need to find. So routinely what would happen after launch, there's things like updating the offering materials and side letters, supporting share classes, coming up with side pockets or new investor types. We would review marketing materials under the new marketing rule. We'd manage the regulatory filings, blue sky laws, and filings of that nature. Also, in what I would call, I guess, high stake moments, times of market stress, some of these terms that are typically more dormant, about gates, withdrawal rights, redemption rights, investor disputes, and then also things like key person events. If there's a regulatory sweep or examination, experienced counsel is really integral to risk management and not just firefighting. So a lot of stuff that we'll do as an ongoing basis that are typical of the life cycle of a fund are included in that. But some typical projects include maybe designing like employee-based profits, interests, or carry and equity incentive plans, doing projects like that, dealing with trademark or intellectual property issues and protecting that. Trademark has become a big thing, I'd say, in the last 7 years. Perhaps maybe because we're just running out of names because there's so many advisors, but it is a real issue when you're running a fund and building a brand. Dealing with co-investment and SVP programs, we'll do a lot of that. Some of us will get involved in compliance related things or even data privacy and cybersecurity programs. There's a lot of policies under Regulation SP that require a lawyer's pen. And then employment agreements that often run into IP issues and retaining IP from employees, things like that. So there's a variety of things that we'll do after the launch.
Makes sense.
Very
there.
cool.
Yeah.
And John, there's one thing we wanted to get into specifically is you mentioned that there's some novel situations when it comes to digital asset funds. Could you talk to us about some of the complications you see there?
Yeah, no, I think it's a timely question. So the digital asset class has some very unique attributes to it and some unique challenges that are evolving. I think the biggest one that we get involved with our digital asset funds, and this is currently in flux, but historically it has been structuring the access to offshore decentralized exchanges through the use of synthetic participation. And there's been a couple of techniques out in the industry that involve total return swaps and participating in profits through trusts by the domestic fund that can obtain economic exposure to the offshore traded portfolio. This is because a lot of the offshore exchanges don't want to have any U.S. beneficial owners involved. I would say, though, with the Clarity and the Genius Act, these techniques, I think, are losing strength, and we're getting to a place where access to decentralized exchanges is evolving in a more positive way. So it's important to stay tuned on that. But in the last couple of years, and even still to this up to the minute, there are some challenges for U.S. managers and how they're able to access some of these liquidity pools that are located outside the United States. One thing that will continue on that we have to deal with is in digital assets is custody, control, and segregation. These are issues that are manifested through defining on-chain wallet controls, identifying and managing qualified custodian pathways where that's applicable, dealing with hot and cold storage policies, even though that's quite technical, it does touch the lawyer's realm. Key person and sharing of keys, that risks disclosures for things that are specific to the asset class, like hard forks and airdrops. The important thing is a lot of these are new concepts, and the fund docs really need to match the operational realities of how these things are being handled. And then one final thing that's always unique with digital asset funds is valuation and liquidity stress. And, that comes about in different ways, but specifying pricing sources and fallbacks for tokens with thin markets, when to use side pockets, suspension and gate mechanics for exchange outages, things of that nature, or even unique protocol events. And then there's things about unique disclosures about stalking and slashing and other issues that fall under, I would say, protocol governance. So those are a lot of, we do a lot of work in that space, and a lot of that takes up a lot of time, unfortunately, and it's a moving target as the regulatory landscape continues to evolve.
Okay, good note. Yeah, we won't dive into all those. I have questions myself, but this is good. I think this is a good, high level.
Maybe for another day. Yeah, agreed.
For sure.
Absolutely. John, as people think about obviously choosing a law firm, right? There's a lot of different aspects. You went through quite a few of those. Any other kind of elements that or factors that funds should pay attention to when looking to hire a law firm or fund formation attorney like yourself?
Yeah, it's interesting. I've been doing this a long time, and I think everyone is different. We've had the benefit of working with a lot of startup and emerging managers. We also work with some iconic managers, but I think for new managers, it's really important, to understand that as much as this is a new world and you're launching a new business and you are a fiduciary, this is serious stuff. You need to pay attention and do it right. Creating a private fund is probably the most linear path to capital formation that there is, meaning that this is not an incredibly complicated or protracted process. And for those of us like you guys that have been involved in dozens, if not hundreds of launches, it's kind of the same path. And by no means am I suggesting this is commoditized, but I think we all know the laws that are practicing in this space. All of the prevailing law firms are fine firms. I think this is more about the value add of the particular firm and a fit culturally. I think what I would do is almost, I'll make a loose metaphor to you. If you're going to a doctor who's a surgeon and maybe a spine surgeon, and they overwhelm you with their brilliance on what they do, but you really are not communicating on what to expect from that service provider. I think it's important for any fund manager to know you're starting a business. Every dollar that you have is crucial. And what's the value proposition? What is this? If you're doing this for the first time, you're not sure what this dance of a fund launch involves. So getting a clear indication of the scope of work, the timing of it, who you'll be working with, what are the challenges you might need to be considering, and frankly, the cost. I don't think that should, I think we're very candid about that. Every pitch we do with a new manager, we're sure to address that. So they walk away knowing what the experience would be like if we're fortunate enough that they choose to work with us.
And John, that's the perfect segue to our last question. Give us an idea of what a fund manager could expect for costs. Obviously, this is just like every other service provider, is going to vary greatly. Whether you go with maybe a smaller group or somebody that's really well established, but kind of give us a scope of costs that a new fund manager could expect, if you will.
Yeah, I think I agree. An accurate answer would be who knows, but certainly there are ranges, and I think there's certain qualifications. And I'm happy to give you my anecdotal experience of what I think the ranges are out there.
Any ballpark should be helpful.
Yeah, if I just could, to help managers sort of qualify. The formation fees will obviously vary by firm type and the complexity of the launch, but really the more dominant cost drivers in a launch are the complexity of the strategy, how bespoke the liquidity and valuation issues might be, multi-jurisdictional bills. That's all going to expand the scope of work. I think, for legal fee estimates, the way I would break it down that makes the most sense is scoping out a very plain vanilla domestic fund, then also comparing the cost to sort of the basic but more elaborate master feeder or mini master complexes. And then a third category of just mega fund complex is what you can expect to pay. From my experience, I think for a domestic fund that's maybe an investment strategy that's routine and straight up the middle and everything goes well, I think $30,000 is really the bottom of the value of a value law firm that you would get. Maybe if you hit it right, it's a little bit less, but I think the range is actually, for a plain vanilla fund like this, from $25,000 to $75,000 just for the launch. That will include all the documents and everything you need to do to launch a fund, but that's what I've seen when it comes to the very basic fund. When you get to a master feeder or a mini master structure, that range sort of is a little bit more broad, and I would say you should look. $70,000 is probably the bottom for a value-added law firm that knows what they're doing, and I've seen that go up to about $250,000 for a master feeder. And then I think when you get up to major fund complexes, the fish stories run abound. But I do think over 250, if you're doing, a fund complex with over 10 vehicles in different jurisdictions, and I've seen some proposals exceed $1 million just to do super complex private equity or fund complex vehicles like that.
Yeah, that's definitely helpful. And obviously, to your point, it always depends. And there's always a menu, right? Depending upon a lot of different qualitative and quantitative aspects of strategy, structure, jurisdiction, all the above, right?
Yeah.
Cool. Well, John, this is great. We really appreciate you sharing your insights with us. Where could people go to connect with you?
Yeah, so the firm is on LinkedIn. We have a website. We publish stuff from time to time. We're also on Twitter, so happy to connect with everyone there.
Amazing. Well, this is great, John.
Thank you once again to our friends at Richey May for sponsoring this episode. If you're starting a fund, you need an auditor. Make sure to give our friends at Richey May a call and tell them we sent you.